If you look at the performance between bond yields, particularly treasuries, and the performance of energy stocks, you'll see they're highly correlated over the last year. When bond yields began to rise, energy stocks also began to rise, and they reached a 1.75, measly in my opinion, 1.75 level, before hitting some chop and then pulling back. You'll see, once the pullback became clear, energy stocks also began to pull back. However, it looks like that pullback should be coming to an end in the treasury yields. In addition, we're seeing fundamentals play out very, very well in the energy stocks. Bond yields are also fundamental, though. The saying that's been going around for years, if not decades now, has been, don't fight the Fed. Don't fight the Fed. Well, we're not going to fight the Fed here, but it just so happens that energy stocks are correlated in some way with bond yields. When bond yields rise, energy stocks, according to the correlation, rise as well. And there's a reason for this. Tech stocks typically pull back as bond yields rise. Why is that? Well, when bond yields rise, they present better cash flow over the long term. You can get a 4% return over the long term instead of a 2% return over the long term. That's attractive. For somebody looking for long-term returns, long-term meaning 10, 30 years, this kind of range, all of a sudden, the bond is a pretty good alternative. If bond yields were 30%, why would you take the risk of owning a tech company when you can get what is virtually a guaranteed 30% from the United States government, right? Doesn't make sense. However, energy stocks promise shorter term, more immediate guaranteed cash flow. In addition, they adjust with inflation. If there's any inflation concerns, which we know certainly exist out there, there's some debate over the total longer term effects of what they will be, but they exist out there. So bond yields right now are below the level of inflation. And like I said, they adjust with fundamentals. It's kind of strange that we see them below the rate of inflation, implying that negative bond yields are the case. But if you ask me, that's not sustainable. However, we don't need that to be sustainable. We can have that be a force that comes in once the fear subsides, because right now everyone in the market is feeling something in their stomach. But if you look at the data, the curve of Delta is showing indications of falling over, particularly the change in the 7-day average. That's the first sign that cases are rolling over. Bank of America says this weekend cases will begin to roll over. As far as I'm concerned, the change in the 7-day average case number decreasing is the sign that cases are rolling over. They will hit that numerical peak and fall down. Today, the Federal Reserve announced or implied that members of the Federal Reserve, by majority, are viewing the chance of a taper happening in 2021. What's a taper? A taper is exactly what, the tapering of exactly what the Federal Reserve is doing right now, which is buying bonds, aka keeping rates low. Why is the Fed buying bonds so important? Well, they are probably, most likely, if not definitely, the largest purchaser in the Treasury market, buying at minimum $120 billion worth a month. It's been higher than that recently, especially. And they've been doing this for several months now, since I believe March of last year. So they are single-handedly the reason that bond yields are so low. Well, seeing one of two reasons. And they just announced that they're going to take themselves out of the market. That spooked the market for a sec. Whoa, scared things. And bond yields fell just a little bit. They were up on the day. The market, towards the end of the day, began to tumble. But bond yields didn't really turn negative, at least on the 10-year. The 30-year is looking a little down. The 10-year, not so down. If this were a real reason for concern, something very significant, some economic altering agenda, we probably would have seen bond yields close negative rather than over most time periods be positive, right? Well, we'll see what happens when they exit the market, but we're losing a big purchaser of bond yields. That means there's less demand. When there's less demand, it means you have to sell bonds at a higher interest rate, promising more returns to get a seller. That means bond yields go up. In addition, we are seeing possibly, most likely, and the data indicates, cases beginning to turn over. Bonds are a flight to safety. We see that the bond curve really began to slope down once we started getting Delta fears, once this thing started, coming on people's radar as cases began to rise in the UK and elsewhere. So one should assume that once cases begin to turn over, people are going to have less need for flight to safety. What are they going to do? They're going to sell their bonds, they're going to stop buying bonds, and interest rates are going to rise. So we have those two forces, implying that bond yields may rise from here. That is a good thing for energy because, as we established, and as we can see quite clearly on the charts, and as we can understand fundamentally, energy stocks and bond yields are correlated. So if we're expecting bond yields to go up, we should also expect energy stocks to go up as well. But there are additionally fundamental reasons why energy stocks, if bond yield correlation did not exist, should also go up. And we can see this just in the news and just in the headlines. There's a supply and demand problem. Energy prices are quite high. Prices at the pump, if you've been filling your car up, you'll notice they're quite high. What the heck is up with this? Well, there's a supply and demand problem. U.S. producers don't want to produce. They just experienced negative $37 a barrel oil. They're scared about the market. They currently have a president who doesn't like oil and has restricted drilling on federal lands. So they have very little incentive to produce. OPEC wants to keep the price per barrel high right now. They're capable of printing a lot of money, and they've set an agreement, long-fought agreement over a couple weeks, which added some serious turbulence to this oil price, over several weeks, and that's their agreement. They've locked in their production until 2022. The United States last week, they've got a lot of information on consumption, on production, on the oil situation. They took the unprecedented step of asking OPEC, the cartel, to increase their energy production. That is unprecedented. Never happened before. They didn't ask U.S. producers to increase their production. They asked OPEC. OPEC said, no, we're not going to increase our production. That means once cases roll over, we're seeing a little chop right here. I believe it's temporary. Once cases roll over, and they are hardcore in China, which has been my biggest fear, we should expect demand to resume the strong upward trend it has been as the economy begins to reopen around the world. These are not day-to-day things. You can't be here day-to-day. You're going to get destroyed. You're going to feel a lot of pain. I, unfortunately, am here day-to-day. So I am experiencing the pain every single day. But I'm able to push through because I understand these forces. And I hope this video has clarified the forces for you as well. They aren't happening overnight. They don't happen overnight. They never have, and they never will. These are macroeconomic forces and concepts that we want to get ahead of because this is where you can find the edge and you can predict the future, at least in a financial and economic way, of what's going to happen. And I'm of the belief that energy stocks are going to rise given these forces, and the prices are quite low right now. So if you have cash, I would be buying. I'm buying when I can. So until next time, peace out.